This three-digit number is quietly draining your bank account every single month. And nobody tells you about it until it's too late. Most people think a credit score is just a gatekeeper for getting a loan. It's not. It's a ruthless pricing engine. And depending on where you sit on that scale right now, it's either building your wealth on autopilot or taxing you thousands of dollars for simply existing. Today, we are breaking down the exact cost of your credit score, from the crushing penalty of the 300s to the elite automated systems of the 800s, and exactly what it takes to escape the trap. Part 1. The penalty tier, 300 to 579. There's a quiet tax most people never hear about. It doesn't show up on a receipt. Nobody circles it on your lease. But if your score is anywhere below 580 right now, you're paying it. Picture this. Two people rent apartments in the exact same city, same square footage. One pays $1,800 a month. The other pays $2,200, plus a double security deposit up front, because the algorithm flagged them as a risk. That's an extra $4,800 a year, going straight into the void. Not for anything tangible, just for existing at the wrong risk level. A score under 580 puts you in what lenders call subprime territory. But subprime isn't just a label, it's a financial penalty box. Auto insurers in most states use it to hike your premiums, even if you have a spotless driving record. Why? The algorithm doesn't care about your specific story. It only reads the math. At this tier, traditional banking shuts you out. If you need $1,500 urgently, you're pushed toward payday lenders charging 300% APR. You pay back $1,900. That $400 gap is just the cost of being seen as risky. It compounds your debt, spikes your stress, and forces worse financial decisions. The floor of this tier is usually the aftermath of a crisis, but the trap isn't being here. The trap is thinking it's permanent. Recovery isn't magic. It's small, consistent, unrewarded payments for months before anything visibly changes on the screen. Part 2. The gray zone, 580 to 669. You made it off the floor, sort of. This tier is highly deceptive. It feels like progress, but it's actually where a lot of people stall out without realizing it. Psychologists call it the good enough effect, the mental trap where you stop pushing once your basic needs are met. You got approved for a basic card. Feels like a win. The urgency fades. But the word approved is hiding a massive premium. Imagine two people buying the exact same $30,000 car. The guy with a 620 score gets a 15% interest rate. The guy with a 740 score pays 5%. Over 5 years, the first guy pays roughly $8,000 more in interest. Same car, completely different real-world price tag. This is the literal cost of being mediocre. The invisible enemy here? Credit utilization. You're carrying a 30 to 40% balance. It doesn't feel huge, but it's suppressing your score entirely behind the scenes. Direction is data to a lender. A score climbing from 600 to 650 signals a completely different trajectory than a score dropping from 700 to 650. If you are moving the right way consistently, you are already further along than you think. Part 3. The turning point, 670 to 739. Something shifts here, not overnight, but crossing into the 670s is when the financial system stops working against you and starts working for you. This is the zone of friction reduction. That low-grade resistance, the rejections, the heavy deposits, the elevated rates, it starts to melt away. You're getting approved for real rewards cards. And here's the secret about rewards programs most people miss. They are a massive wealth transfer mechanism. They are funded by merchant fees and, disproportionately, by the interest paid by people stuck in the lower tiers. At 700, you are finally on the receiving end of that transfer. Mortgage rates drop meaningfully here, saving you hundreds a month. But the biggest shift is psychological. When you stop bracing for the rejection email, your entire relationship with money changes. Decisions made from security look completely different from decisions made from scarcity. You stop surviving, and you start taking calculated risks. But beware of complacency. 700 is comfortable. But the next tier isn't just about comfort. It's a completely different category of wealth. Part 4. The elite tier, 740 to 850. This is where the rules change, not just the rates, the rules. At 740 and above, you stop going to lenders. Lenders start coming to you. You are no longer a risk profile. You are an asset. The difference in mortgage rates here on a $500,000 home can translate to $60,000 to $80,000 in saved interest over a loan's lifetime. That's not just cash. That's a decade of compounding interest in an index fund. Premium cards here offer airport lounges, concierge access, and travel credits that heavily outweigh the annual fees. You are extracting massive value from the very system you used to just fund. But here is the real secret of the 800+ club. It redefines the difference between income and wealth. At this level, credit becomes invisible infrastructure. You don't think about it anymore. It becomes an automated system running quietly in the background, minimizing your expenses and maximizing your leverage. Reaching this tier requires shifting from an external need for approval to a strict internal scorecard. It's the quiet, undramatic discipline of paying in full, keeping utilization near zero, and letting time do the heavy lifting. The algorithm finally treats you like it trusts you, because, mathematically, it has to. Your credit score is not your identity, but it is the mathematical reputation you carry into the world. And where you are on that scale right now is not where you have to stay. If you are stuck in the gray zone and want to build the exact automated system that pushes you into the elite tier without needing a raise, click this video right here, where I break down the entire blueprint. I'll see you there.